Hey, welcome to the podcast, everybody. Thank you for joining me. Today is April 10th. It's Thursday, and it's Bloody Thursday today on Wall Street as the stock market completely reversed all of yesterday's gains and then some, a lot some. Let's go through the numbers real quick here. So we've got the Dow Jones was down 267 points, about 1.6%. The S&P down 39 points to 1833, down over 2%. The NASDAQ was hit the hardest, down almost 3%, 125 points. And not shocking, bonds did very well on the day, and gold did very well also. So again, the theme for this year kind of worked today, which is stocks struggling, bonds doing pretty well, gold doing pretty well. Now let's talk about what happened over the last 24, 48 hours. We came into the last few days, and we were kind of in this range, weren't we, where the market really wasn't doing much, and we were in this little box, and everybody was essentially buying the lows here and selling the tops, and we had it again here. Although this time everybody thought we were going to go back up at the top, and we didn't. Well, here's what happened yesterday. What caused a little bit of a rally yesterday was we had two really bad down days. And internally, we've been talking about and writing about that there's been this rotation going on. We put that article out yesterday about the rotation that had been going on out of high growth stocks, very expensive stocks, into undervalued or cheaper, dividend paying stocks, grandpa stocks we'll call them. And this rotation, that didn't mean the market was falling apart, but we have seen some things lately that we didn't see during the January correction. The January correction, which was worse than what we've seen so far at least, this was very news driven, and at that time we said we're not doing much about it. Well, this one's a little different because we've seen some big deterioration in here, and some of our longer term indicators are starting to weaken. Having said that, that doesn't mean that we believe the bull market's over just yet. It could be, but it may not be. What we're looking at is really the short to medium term. And the short to medium term looks like we're starting to set up for a correction. And you can see the rotation happening out of small caps, out of biotechnology, out of some of the high flyers into the safe areas where you're getting, some of the things like utility stocks holding up extremely well. REITs, gold, treasury bonds, all those things. So that rotation's happening. But this one is a little different than this one. The correction we're going through now, I think, is worse. And even though the points aren't worse necessarily yet, I still think that we're going to head a little lower. Look, I'm not short the market yet. I'm not positioned to benefit from a falling market. But relatively speaking, I'm positioned much better than the overall market because of the fact that I do own some gold. I do own some utilities. I own some bonds. I don't own exclusively high-tech beta stocks getting hammered. So there's places still to hide out in this market. That's what's interesting about it. Today was more difficult than what we've seen, but still, on a relative basis, there are still places to be. If you look at utilities, they were barely down today, whereas the NASDAQ was down almost 3%. But here's what happened yesterday. Yesterday, we got the Fed minutes, and the market was so happy because I don't know why, to be honest. I read them, and I didn't see anything different. The Fed's going to try to raise interest rates next year in 2015. Whether they do it in April, May, June, or October, to me, it's really irrelevant. The point is that they're telling you we're going to start raising interest rates at some point in the future, probably next year. And in the meantime, we're going to continue to do our tapering, and we're going to not buy as many bonds as we've been buying. That's what they're saying, and the market's adjusting to that and having a difficult time with it. And I'm not sure why everybody was celebrating yesterday when those Fed minutes came up, because I didn't really see anything different in them. So that was a little confusing to me. So I didn't run out there and buy the Facebooks and Netflix and all those at the highs. I'm sure somebody did. Somebody probably said, oh, great, I'm getting a bargain on those things, and only to see them get smashed. If we take a look at 5-minute picture, let's take a look at Biotech, for example. So we know Biotech, and this is a 5-minute picture going all the way back to the beginning of the month. Biotech had just been getting hammered. We knew that. So we saw this drop, and then it started kind of moving sideways. So I saw a big move yesterday, and everybody was jumping on board, especially after the Fed. Hey, this is a bargain. And the IBB went from 235 today and went straight down to 221, a 5.6% drop, a very big drop. So that's what's going on with biotech. It's now officially in a bear market, which is 20%. Now, I look at bear markets, and I've explained this before. Bear markets, to me, I don't know. I think it's semantics, but I think they have more to do with duration than they do point-wise. Obviously, if something falls 50% in 2 days, yeah, you could say it's a bear market. But I look at it as still a really nasty correction. Yes, it's officially 20%, but if this went on and it was 30% over a year, that would be a bear market. I just look at it as a really nasty correction. But again, doesn't matter what you call it. If you bought biotech up here, you're suffering because it's been a 20% decline. Now, people will look at this and say, okay, we're getting close to this 200-day moving average, which we are. Is the uptrend broken? Here's a weekly picture of biotech. And this goes, if we take it back to 2009 here, does the uptrend look broken? I don't know. What's interesting about it, though, is that we're getting a bunch of volume coming in here, lately that we haven't seen before. So right now you're getting a lot of volume. Look at all that volume right there. So we're getting a big spike in volume, institutional selling. Yes, this uptrend right here does appear to be broken. Do we retrace all the way down to here? I don't know. Some people are calling for, 30, 40, 50, 60, 70% drops in biotech stocks. So, for those of you who think there's a bubble, there are bubbles in the stock market. I don't think the overall market is a bubble. I think there are certainly pockets of it, and biotech is probably one of them. Those companies are just extremely expensive. But to me, this isn't really about the Fed. This isn't about Russia. To me, this is just trading. This is just somebody hitting the sell button, and it's snowballing. It's a piggyback type market. When something goes one direction, people piggyback on that trade. Oh, my neighbor's selling biotech? I'm going to go sell it. My neighbor's buying Facebook? I'm going to go buy it. That's what this market has been lately. And for most of you, it's kind of a frustrating market because it's not going anywhere and gyrating. But again, what I would do is focus on what is working. That's number one. And number two, take advantage of some of these really down days. If we get another really nasty day tomorrow, I'm going to be looking for things to buy. Is it because I think the stock market has officially bottomed? No. The reason I would be doing that is because in the very short term, when you look at, hourly pictures, for example, it's getting oversold. It goes from oversold to overbought. So you have to look at it and say, okay, well, even if you're wanting to trade some, if it falls down to here and then it bounces back up, that could be a really nice trade. So part of your portfolio, I think you should have some of your powder dry to take advantage of that. That's why you have the cash you have. On the flip side, in regards to the investments, it's a process. If this market is rolling over and it becomes a process, you have to methodically reduce risk in your portfolio as that happens. So as different indicators get more and more negative, we will continue to reduce risk. And those are two different strategies. An aggressive strategy is taking advantage of the weakness. That's what an aggressive strategy is. I'm going to buy on red. A more, let's call it core strategy, would be one whereby you see that things deteriorating, and as they deteriorate, you start checking things off the list. Okay, now I've got 3 things that have deteriorated, now 4, now 5, and you start reducing your exposure slowly but surely. And that's okay to have both of those strategies. And then, of course, you've got your longer-term investments that maybe you're just going to leave. But that's about building a portfolio. Right now, in the short run, we are look, last year, for most of the year, the 100-day moving average was the thing that worked. Okay? And then it broke down here and it faked some people out because once it broke and didn't come back, everybody panicked a little bit, but it took it about 3 days to get back above it. So the 100-day is now back in play again. Is it going to break this time even bigger? Who knows? So don't overtrade here either just because, the market's vibrating a little bit. We've been used to no volatility in this market, and now we're starting to get some, okay? But just because that's the case, you could easily get whipsawed. You don't want to be the guy that buys yesterday and then sells today only to see it bounce again tomorrow. We're still in a range here. Yes, we broke it a little bit, but we do have some support at the 100-day moving average, which is just a little bit lower than where we are right now, about 1/3%. and that would be the first line to bounce off of. So we could easily come down, bounce off of that, but if we start making lower highs, look out, because that's what happened in the NASDAQ. If you take a look at the NASDAQ, these lower highs, you can see it. Let me take this line off here. In fact, let me just flip it around. These are the lower highs I'm talking about. So could we bounce again, work our way back up to here and fall? We absolutely could. But this NASDAQ looks troublesome, doesn't it? It clearly has broken below its 100-day moving average. And now what you look for is, as this starts to roll over, is it going to peg the underneath side of it and we start making lower and lower highs? So do you have cash? Because you should have some cash right now. Do you have some things that are moving a little differently than the market? And are you at least in the market in some things that are working? Do you own utilities or gold or things like that? Or are you still stuck in the 2013 stock market? This is a different year than 2013. It may turn out to be the same. The next 9 months may go straight up. We don't know. But what I'm telling you is there's been enough cracks lately that there's been some red flags that have caused me to get a little more on guard than I was back in January, even though January the markets were lower. That's very important. There's much more deterioration and negative signals I'm seeing now, even though the market's still a little higher, than what we saw back in January. But I will tell you, for those of you that are very, very tactical and short-term oriented, if you have cash and you see some really violent sell-off tomorrow, that's what you want to take advantage of, because you could make a trade where a particular stock may go up 5, 6, 7%. That's a very short-term trade, and maybe you should have a portion of your portfolio in that if that's what you're into. If you're not, if you're just saying, hey, Karl, I'm worried more about my 401k or my long-term portfolio, what should I do? We are incrementally reducing risk in the 401ks that we oversee. We're incrementally reducing risk. That just means that we're saying, look, there's been a few trouble things. We're going to reduce a little bit, right? A few little indicators get negative, we're reducing it. And we'll continue to do that if the market continues to give us those signals. And look, it's not about just the points. The fact that the Dow Jones is down 270 today and was up 180 yesterday, yesterday's strength was very, internally it was not all it appeared to be. Today's was more reflective. Today was probably close to a 90% down day. That's a pretty nasty day. And yesterday, even though it was up a lot, it wasn't that strong of a day. It wasn't like it was anywhere close to a 90% up day yesterday. So you have to look internally every day at what's going on, even if the market up on the points looks the same, and it's not. So we're seeing some deterioration right now, and it's just a yellow flag, I'd call it. So incrementally reduce a little bit of risk, but do we toss in the towel and say, okay, that was the top, I'm getting out of everything in my 401k? I'm not doing that yet at all. And when we start reducing risk more, we will tell you. But for right now, there are still some places to hide in this market, okay? When we get into a real nasty market, there won't be any place to hide. That's kind of the difference. All right, thanks for joining me. Hey, by the way, new website, go check it out, eggerscapital.com. You probably saw we have a new distribution way of getting you these podcasts, but go check out the new site. Let me know what you think about it. Thanks, guys.